15 revenue from contract with customer. There are five stages or steps in order to recognize a revenue. Previously it was IAS 18 and IAS 11. Now it's all about IFRS 15. How and when an entity will record its revenue as per IFRS 15. Let's read five stages. These are very important stages. Even in your interview for job, the interviewer will ask these questions in most of the time. Identification of contract, identification of performance obligation, transaction price, allocation of price to separate performance obligation, recognize revenue. Now, with the stage 1, identification of contract. In identification of contract, we have three things. One, terms should be defined, means the term of the contract should be clearly defined. There is no hidden things or hidden terms. There should be an enforceable legal right by law, means legal right enforceable by law, probable chances of economic benefit from buyer perspective. First read legal right enforceable by law. It could be implied or non-implied. Implied means by act or conduct. If the contract is implied, then you will have to book revenue. If the contract is non-implied, then in that case, you will have to book revenue only when the contract is written. What is meant by implied contract? It's not a written or a verbal contract. Let me give you an example for better understanding. Let's say you are in a restaurant and you ordered a food. Once you receive your order, you eat your food, then you will have to pay. No one is going to ask you to pay me for this food because it's your intention that you are going to pay once you will get your order. So it is implied contract, and non-implied means written or. Now, what about probable chances of economic benefit? You will have to check this criteria from buyer perspective, means check financial condition of buyer, whether the buyer is feasible or technical sound, that buyer can purchase your product. Guarantees, if there is any guarantee associated with the product. Importance of that asset for buyer means whether acquired for use or resale. Either the buyer acquired it for the personal use or for the investment opportunity. Payment terms. Deposit amount should be material, means the amount you are getting should be material. Stage 2. Once stage 1 is completed, now move to the stage 2. Stage 2 is very important. Very important. Identification of performance obligation. Performance obligation means you have fulfilled your promise, your duty, means you have no more obligation. You have written down, you have performed, provided separately and benefit separately. What is meant by provided separately? The entity promises to provide that goods or services is separately identifiable from other services in the contract. It means the entity offers a bundle of goods and services. Provided separately means the customer can use it by itself and the good/service is not bundled in a way that it's inseparable from other items in the contract. Examples: a software and a one-year maintenance service can be provided separately, means you can acquire software from another party and the maintenance service from other. So there are two performance obligations. A car with built-in GPS that can't be separated or used on its own. They have dependent on each other. Is not provided separately. So it's one performance obligation. In case of more than one performance obligation, it is called provided separately. It means goods and services are distinct. If the goods and services are not distinct, then it's can't be provided separately. It's a single, or you can say one performance obligation. Now benefit separately. The customer gets benefit from those goods or services separately, means The customer can use the good or service on its own or together with other resources that are readily available to them. There is an example for you in case of benefit separately. Mobile phone plus SIM service. Phone can be used on its own or with another SIM can benefit separately. Software license plus installation service. If the software works without installation, can benefit separately means you can get the software without installation as they both are distinct. If the software is useless without installation, then it can't be benefit you separately. Means if you are not going to install the software, then you can't use. Same goes for the Windows. If it's in your laptop, you can't install the window in your laptop, then you can't use the laptop. So it means you can't get the benefit separately.
Now move to the summary of both terms. Benefit separately and provide separately, meaning customer can use the goods service alone or with available resources. Provide separately, the goods service is not highly interrelated or bundled in the contract, means the entity is going to offer separate things. And in benefit separately means the customer getting benefit from those goods and services separately. Both conditions must be met for a good service to be distinct performance obligation under IFRS 15. Examples of distinct goods services scenario: phone plus SIM plan, distinct, yes. Why? Both can function independently. Without SIM, you can use your phone. Laptop plus carrying case. Yes, each item provides benefits separately. Laptop has its own benefits and case has its own benefit. Software plus mandatory customization installation. No, why? Software depends on customization to function. Same goes for the laptop. If there is a Windows, then they are not distinct. Why? Because without Windows, you can't operate your laptop. Same goes for the Apple or MacBook. If there is no iOS, then you can't operate your MacBook. Car plus free first service. Of course, distinct. Why? Service is separate and adds benefit. If you are not going to take this service, then instead you can use your car. Now, examples of separate performance obligation. These are goods or services that are distinct and meet both conditions, benefit separately, provided separately. Contract includes a mobile phone and 12-month SIM plan. Separate performance obligation? Yes. Why? Both can be used independently. A laptop and an optional extended warranty. Yes. Why? The warranty is a separate service the customer can choose. It's up to the customer. A TV and a wall mounting service. Yes, the TV works without the mounting. Mounting is a distinct service. Software license plus training session. Yes, training is additional and not essential for using the software. Now, example of single performance obligation. These are good services that are not distinct, means they are not separate because they are interrelated, integrated, or dependent. Contract includes a customized software that must be installed to work. Single performance obligation? Yes, single. Reason: software and installation are interdependent. Machine and significant on-site assembly. Single performance obligation? Yes. Reason: the machine can't function without proper assembly. A building contract with design plus construction? Yes, single. Combine into a single output, the building. A car engine with essential integration service? Yes, single. Why? Engine can't function or be used without integration. Same goes for the paper. If you are going to take single paper from your tutor, then it's a single performance obligation. Now you can realize how much time I have spent on this stage 2, because I can assure you this stage 2 is very, very important. even for your exam perspective and in your future professional role as well as. So before moving to stage 3, I am asking again, if you have any queries, you can ask me anytime. Now move to the stage 3. Once we have identified the performance obligations, we identify transaction price. Transaction stage 3 is divided into two parts. A, identification of transaction price and significant financing component. First, read identification of transaction price. Transaction price include two kinds of consideration. Variable consideration, sales on return basis. What is variable consideration? Variable consideration can only be booked to the extent where reversal is impossible. Example, penalty, incentive clause. It means, let's say you are constructing a building for a third party, and a party says, if you will construct this building within 1 year, then I will give you an incentive. This incentive means it's fixed that you will get the incentive if you will construct the building within 1 year. So this incentive will become part of your revenue. Also, if the customer asks you that if you are going to delay the construction, then you will be penalized. In that case, if the reversal is impossible, then you will have to book the variable consideration. There is one more important point. Non-monetary considerations will always be recorded at fair value. Non-monetary consideration means other than cash consideration. Now in IFRS 15, you can book revenue on sales or return basis where sales is confirmed. Now read sales on return basis. Sales on return basis is an arrangement where goods are sold to a customer with the right to return them within a specified time if they are unsold, defective, or not needed. Means we sold to a good to a customer with the right to return them within a specified time if customer find defective or not needed. Key features: no final sale unless goods are accepted or return period expires. Often used in industries with uncertain demand, books, fashion, electronics, risk and rewards of ownership do not transfer immediately. Accounting treatment as per IFRS 15. Revenue is recognized only when it is highly probable that goods will not be returned to the entity or the return period expired. If these two criteria, there is an or means if one of the criteria is met, then you can book revenue. If returns are expected, recognize revenue only for the portion not expected to be returned. Of course, if it's returned, then it is not a sale. Then you will have to record it in your inventory as an asset. Recognize a refund liability for a expected return. Create a right of return asset for goods expected to be returned. Measured at cost. There is an example for you. A company sells 1,000 shares to a retailer on return basis, means retailer has a right to return. Past data shows 100 shares are usually returned. The company will recognize revenue for 900 shares, create a refund liability for 100 shares, recognize an asset for the cost of those 100 shares expected to be returned. I want you to all write a journal entry of this example. I've explained everything in this example, but I just want a journal entry from all of you. Note, if there is a variable consideration and uncertainty, then entity should choose either an expected value model or most likely outcome to estimate the amount of the variable consideration. Whichever estimate is better, pick that one. We have discussed these two models in IAS 37 provision contingent asset contingent liability topic. Now move to the part B, significant financing component, stage 3 part B. Significant financing component means when the entity receive payment in advance but provide service or goods after a year. Also, when the entity provide goods and services in advance but receive payment after 2 years. So it could be any one. Material difference between time of service and time of payment, difference between date of providing goods and receiving payment. There are two cases. Case 1, entity A provides services now and will receive payment of 1,21,000 after 2 years. Interest rate is 10%. Why there is an interest rate? Of course, it's a significant financing component as you will receive the payment after 2 years. After 1 year, the entity start receiving an interest on this payment. Now solve this example. In this case, entity provides services in advance but will receive payment after 2 years. Of course, in this 2 year, entity A will earn some interest income. Let's create journal entries. Receivable, debit, sales, credit. Why receivable? Because we have not received the amount. So receivable, debit, sales, credit by 1 lakh. How this 1 lakh is calculated? 121,000 is the future price which we will cover after 2 years. So 121,000 divided by 1.1% raised the power 2 will give you a present value of 1 lakh. Also, you can use the formula is P equal to F means future value divided by 1 plus interest rate raised the power number of years, so which is 2. Now during 1 year, receivable debit, interest income credit. Interest income 1 lakh multiplied by 10%, it's 10,000 income for year 1. 11,000. How 11,000? 1 year is the present value, then entity earn 10,000 interest during the year, so it makes a 11,000. And on 11, then on that 1 like 11,000 multiplied by 10% give you 11,000 interest income. And at the end of year 2, you will receive your amount which is 121. So you debited bank and credit receivable by 121,000. Now there is a case 2. Entity A receive payment now and services will be provided after 2 years and interest is 10%. In this case, entity A receive payment in advance but will give service after 2 years. So it means now if you are receiving anything in advance, it treated as a loan. So in year 1, the entity A makes an entry bank debit loan or contract liability credit by 1 lakh. Now in this case, entity A will pay an interest expense debit loan credit 10,000, interest expense debit loan credit 11,000, and the end of year 2, you are going to book the sale. Now in that case, you will have to debit your loan debit, sales credit, because at the end of year 2, the sale means the control has been transferred. So at the end of year 2, when the control transferred, you will book the revenue. Now stage 4. Stage 4, allocation of transaction price. Total price is allocated to different performance obligation on the basis of stand-alone prices. We have discovered the performance obligation in the stage 2. So total price is allocated to different performance obligation on the basis of stand-alone price. Example, generator plus 2 year maintenance service price in bundle means in a single package is 1200, even though individual prices of generator is 1000 and 2 year maintenance service individual price is 5000. So it means if you are going to purchase these two things separately, then it will cost you 1500 and in the bundle it will cost you 1200. Now how will you calculate the standalone prices? Standalone prices of generator and 2 year maintenance service is generator is 800. How 800? 1200 bundle price multiplied by this individual generator price divided by the total price of these two is 1500. It will give you 800. Now maintenance service, it's 400. How? 12,000 the bundle price, 500 the maintenance service price divided by the 15. 100 of these two total price, so it will give you a 400 figure. Now the entry for recording the revenue: bank debit by 1200, income means revenue by 1000. How 1000? It's 400 plus 800 means 1200. But why I record revenue as 1000? Because this is for the 2 year maintenance service, and we are in the year 1, so I will receive the service for 1 year. That's why I have divided this 400 by 200. It give me 200 figure for the first year. So this is my first year income: 800 generator and 200 maintenance. The next 200, remaining 200, will be my deferred income. Means once I will provide the warranty in the next year, then I will record this 200 as my revenue in the next year, and in my current year I will record it as a deferred income. Next year service standalone price. Now last stage, book revenue. When we recognize or book revenue, there are two methods: point in time and over time. What is mean by point in time? Point in time means when no performance obligation for future. Means you have transferred the control, you have transferred the legal title, risk and transfer. Means you have no obligation for future. So in that case, you can book your revenue at a point in time. Book revenue when control transfer, hints of control transfer, possession transfer, legal title transfer, risk plus reward transfer. Over time, when customer getting benefit simultaneously. Teaching. How teaching? Let's say you are enrolled in my course for 6 months. So in that case, I can't recognize your fee as a revenue in month one because I have been teaching you for 6 months. So I will have to record your fee as my revenue for the 6 month period. When seller performance creates an asset which comes under control of customer. Example, construction at customer's plot means when the customer getting the benefit through construction, then we will record the revenue over time. Seller creating an asset which is of no use to seller, plus seller has right to receive payment for work done. It means when a seller, let's say entity A, is creating a specific asset, you can say a unique asset, on demand asset for a customer. So in that case, we will record, or entity A will record the revenue at overtime. Past paper pointers. These are the pointers which I have extracted from your past paper. Company A sell goods to B, but B pays to company A when B sells to end consumer. First, company A sells to B, but B says I will pay to company A when B sells to end consumer. In this case, company A books revenue when company A transfer goods to B, not when B sells to end consumer, because company A has transferred legal title, risk and reward to B. So it means in this case, revenue is recognized at point in time when legal title is transferred. Pointer number two, we will transfer title to garden center. When garden center sells to a customer, even though the garden center has a physical possession of goods. Garden center has a physical possession of goods, but it doesn't mean that the physical possession has been transferred to garden center. In this case, revenue book when title transfer at point in time. Physical possession only gives evidence about right to sale, not right to retain. So right to retain is very important rather than right to sale. Right to sale is kind of a contract, or you can say
agency relationship in which, okay, let me give you an example. I am hiring a person and I will have to pay monthly 100K to that person. I ask them, this is my asset. If you can sell in the market, I will pay you this thing. So it means I have transferred my legal title to that person. No, I have not transferred my legal title to that person. I have just giving him the right to sell. Means if he can sell in the market, then I will pay him 100K. So these are very important pointers. Now there are other small topics. Warranty provided and benefits separately. This warranty, if provided and benefits separately, means distinct goods and services, then it can be extended. How? Normal car selling plus warranty service selling. If you are going to purchase a car from a showroom, then you can extend your warranty service selling. Treated like two different performance obligation, of course, you can also ignore the warranty service. Book revenue of car immediately plus warranty service outcome. Okay, I am a car showroom owner and whenever customer come to me for any car, I sell car as well as warranty service. I offer them to take car and warranty for 2 years at 1,20,000. In that case, I debit my bank because customer pay me 1,20,000. But I booked sales at 1 lakh. Why? Because warranty will be provided after 2 years. So in this year, I just sell car, not warranty, as warranty will be provided from the next year. So that's why I have booked it as a deferred income. Not provided and benefit separately means by law, by culture, standard warranty. If they are not provided and benefit separately means goods and services are not distinct means they are interrelated or dependent, then in that case it assumes as a single performance obligation. In this case, you will book P&L debit me and warranty provision credit. You are familiar with this entry. We have made so many times such entry. Franchise. In case of franchise, the fee, commission, royalty can't be recorded as revenue in one go as there are other performance obligations associated with franchise agreement. Modification. Change in scope, price or duties and contract. If during the year there is a change in modification, let's say in the price, scope or duties of contract, then how will you treat this situation? I have written down in two things. First, separate contract, not a separate contract. When a modification will be considered as a separate contract. Point number one, goods and services are distinct means they both are distinct, are separate goods and service. Consideration charge for additional goods or service reflects stand-alone prices. Stand-alone prices of goods and services. Stand-alone prices means separate prices, not in a bundle. Book modification as a separate contract. If these two conditions are there in the modification, then you will have to treat it as a separate contract. When the modification will not be considered as a separate contract, if goods and services are not distinct, means they are not separate, they are interrelated or dependent. Consideration charged for additional goods or services does not reflect stand-alone prices of goods and services, means the consideration charge for additional goods or services are in a bundle in a package price. Merge it with existing contract, no need to book separate contract. Then you will have to treat this contract as the existing contract. Do not need to book it as a separate contract. Only separate contract will be booked in case of modification if these two conditions are fulfilled. Now there is a construction accounting format or a concept. Performance obligation satisfied over time. I have explained in the stage 5 this thing, over time thing. So in case of construction accounting, there are four steps. in which you will have to book your revenue. Step 1 is compute total profit and loss. You don't need to worry about stage of completion as it will ask by the examiner to use input method or the output method. So you don't need to worry about the SOC. It will be given by the examiner. So step 1, compute total profit loss, total revenue less total estimated cost. If profit is expected, then book it according to stage of completion. If loss is expected, then full loss should be booked now. Prudence. If there is a loss, then it means it's an onerous contract. Then you will have to book the loss. Then you can't go any longer. Why? Because your contract is in loss. If it's profit, then you will move to step 2. Step 2 means stage of completion. How will you calculate stage of completion? Two method, input method. Input method means stage of completion equal to cost incurred to date. Means to date you have incurred whatever cost will be divided by the total estimated cost. Total estimated cost include cost incurred to date and further expected cost. Means the cost you have incurred till now and in future whatever cost will be incurred. So these two costs will be added and cost incurred today will be divided by the total estimated cost multiplied by 100 give you a percentage. And in the output method, value of work certified to date means whatever work you have done to date and the price of this work will be divided by the total contract price, total revenue multiplied by 100. Once you calculate your SOC, then in step 3, you will have to multiply your revenue by this SOC percentage. Also, you will have to multiply by your total estimated cost with this percentage. Then in step 3, you will also calculate the profit as you have calculated in the step 1. After that, step 4, SOFP extract. Actual cost incurred to date, add less profit, loss recognized to date. If there is a profit, then you will have to add. If loss, then you will have to less. Less progress billing, contract asset or contract liability. If it's a liability, then you will have to book it as a liability. If asset, then record it as an asset. Now, last topic, which is consignment basis, explained. Consignment basis is an arrangement where goods are sent to another party, means the consignee, who holds and sells them on behalf of the seller, the consigner. The ownership remains with the consigner until the goods are sold to the end consumer. Key features: title and risk remain with the consigner until sale. The consignee does not purchase the goods, they just facilitate the sale. Payment to the consignor is made only after goods are sold. Common in industries with widespread distribution, FMGC, electronics, books, accounting treatment. Revenue is not recognized when goods are delivered to the consignee. Why? Because we hire consignee just for the sale purpose. Revenue is recognized only when the consignee sells the goods to the end consumer. In this case, legal title transferred to the end consumer. Then consignor means we book the revenue. Until then, the inventory remains with the consignor, the seller. Key signs: it's a consignment. The consignee does not control the goods. The consignee can return unsold goods. Payment is post sale, not upon delivery. Means once payment is made once the sale has been made to the end consumer, not upon the delivery to the consignee. Example: a clothing manufacturer sends 500 shirts to a retailer under consignment. The retailer sells 300 shirts in July. The manufacturer consignor will recognize revenue for 300 shirts sold, keep 200 shirts in inventory until sold or returned. Summary: consignment basis, no sale until goods are sold by consignee. Ownership, risk, and rewards remain with the consignor until the final customer buys, means until the consignee sales to the final
or end consumer. Sale and repurchase agreement. What is mean by sale and repurchase agreement? Let's say I have purchased an asset from you, and in that case I have also noted down that you ask me that after few months or years I will take back my asset from you. So it means sale and repurchase agreement. Previously you sold me and later you will repurchase from me. A sale and repurchase arrangement is when an entity sells an asset but also agrees or has an option obligation to repurchase the same or similar asset at a later date. Key features: not a genuine sale if the repurchase agreement limits control transfer. Often used to raise finance, not to actually sell the asset. Common in finance transactions like repo repurchase agreements in banking. Accounting treatment IFRS 15, IFRS 9. Let's forget about IFRS 9 because we have not covered IFRS 9. If repurchase is a forward contract or a call option, means seller right. In my example, you were the seller. The seller retains control, means you have control, so no revenue is recognized. Why? Because you have an option that you will get back the asset from me after few months or few years. So it's not a sale. Then then how will you record this transaction? Treat it as a financing arrangement. The sale proceeds are a loan. The amount you have earned or generated from me on this asset will be treated as a loan. Why loan? Because after few months or years you will take that asset from me or a loan, and the asset remains on the seller's balance sheet, means your balance sheet. Now, if repurchase is a put option, means buyer's right to return. Now it's my right to return. Assess whether the buyer has a significant economic incentive to exercise the option. If yes, financing or lease. If no, may be treated as a sale with a right of return. It means if the option is in my hand, what if I am not going to give you again? Then of course you can't take back from me. In that case, you will have to book revenue. Why? Then it's a proper sale because you are not going to repurchase this asset from me. There is an example. A company sells a machine for rupees 10 million and agrees to buy it back after 12 months for 10.5 million. Company is you, and those who are going to purchase this machine is me. This is not a genuine sale, it's a financing arrangement. The company keeps the machine on its book. It's still your asset, records rupees 10 million as a loan, recognize interest expense of rupees 0.5 million. Why 0.5 million? Because you sell this asset to me at 10 million. Now you are going to take back from me at 10.5 million. So it means this 0.5 is an interest. Summary: sales with repurchase equal to no actual transfer of control, so no revenue is recognized. It's usually treated as a loan financing arrangement. So that's it for today's topic. If you are facing any difficulty or any issues in today's lecture or previous lecture, feel free to ask me. You can contact me on my WhatsApp group. I have made SBR AAA, ATX, and SBL group. So if you have any query, you can ask me anytime. Best wishes. Take care. Good night.